Good morning once again. It's all things the pound. This is the euro pound future, and what's happened yesterday was we came close to that black line weekly support, and we reversed. That's a time continuation signal, and we closed above the third range deviation pivot up, which indicates an expansion of range beyond the norm. But what our traders are then doing is zooming into the 60-minute, and we've got all our same levels based on peak expansion. And the thing that makes this more interesting than some other potential signals is this red line here. So this is a half-day line, so it is a major short-term support, but what makes it even stronger in their eyes is how far it goes back since it last changed. So all the way to middle of July. So that line had not changed for 2 months. Actually, it's a little bit further back than that. I thought it might be. There we go. So that line hadn't changed since the end of June. So the longer the time between the line changing in value, and that applies to whether it's a weekly or a monthly or any of these half-day lines, the more important it is. I'm going to return to the daily charts, and we have cable, and that has also produced a signal, but because it's not at resistance, it's only for the most aggressive, and that is a bear cage signal. And I'm just going to highlight what a bear cage signal is. So I'm just going to do a normal chart. So just doing a normal chart, call up time average bands, which is this one here. Right, there we go. And these are my creation, really along the same lines as Bollinger Bands, although I think they're, not surprisingly, I think they're better. But the reason why I think they're better is they're not based on close to close. It's based on the relationship of range to range. Also, this moving average through the middle is variable, so it can go from anything from a 3 period to a 21. So if we get an expansion of range, the average speeds up, and if we get a contraction of range, it slows down. So you can get some real periods of condensed activity, and then they will start blasting out. You also get up to 4 standard deviations. The code is very simple. We've moved beyond the 4th band, and then we've reversed. And that's all a bear cage is. If it's a bullwhip, it's the opposite way around. It is a very aggressive signal in this instance, but for those traders who bought the breakout on the Bank of England on Thursday, it would be enough for them to say thank you very much. You'll take some profits. Okay, that's it.